Up on the show today, we have a very special guest, and this is especially a company that comes in terms of the early stage startup fund, Unicorn India Ventures. Now, they announced the first close of its rupees 1,000 crores. Now, with the new fund, Unicorn India Ventures is looking to back 25 startups operating in a global SaaS and digital platforms, where the fund already has quite a good of an expertise over there as well. So let's bring on board Bhaskar Majumdar, managing partner at Unicorn India Ventures, to talk more about that. Mr. Majumdar, thank you so much for joining in with us this evening on ET Now. And let's start by just, if you could take us through the close of the Fund 3. What kind of companies are you looking at over here? What are the details for this?
So we just announced the first close of our Fund 3. The Fund 3 is a 1,000 crore fund, and the first close is at 225 crores. Unicorn India Ventures, we are known to be the first institutional investor, so we go in very early in the companies. And our typical strategy is we invest 20% of our investable corpus as a first check, and then we invest in follow-ons as the companies scale up. That is the same strategy we have retained. One big differentiator we have is, unlike most funds, we tend to invest throughout India. Especially the course of our investment strategies in tier 2 and tier 3 cities. And that's what we are carrying on. In the Fund 3, the first investment we have made is a clean tech company based out of Bhubaneswar. And so we are carrying on with the same strategies that has exhibited substantial return to our investors in Fund 1 and Fund 2.
So if you could just tell us, how many companies actually are there in the current overall portfolio, and how is the current portfolio faring as well? What is the update on that front?
From the first two funds, we have invested in about 35 odd companies. The first fund, which was a 2016 fund, in that we have returned north of 2.5 times to our investors, and all the companies are doing fairly well. In the first fund, we have given substantial exit, and we still have assets worth another 5-6 times the fund size left. The second fund was a 2020 fund. Bang in the middle of COVID, we did the closure. So it's still very early days. We have created the portfolio of 20 companies, and most of the companies have gone into subsequent rounds. And it's still very early days to predict the size of the fund success. But on a present NAV basis, it is at about 1.4 times.
I want to understand more in terms of what kind of sectors would you be looking at to enter as well? What are the sectors that you're looking at as of now? Especially, yes, I believe that you have the expertise in SaaS as well as digital platforms. So would that be a continuation over there as well? And furthermore, those are the sectors that you would look at.
Have two broad investment strategies. We stay out of consumer internet. We stay out of content. Fundamentally, we stay out of those businesses where you need a lot of marketing dollars to be able to scale up. We invest in two broad themes, like you very rightly said, Aman. One is the whole B2B SaaS, which is made in India for the world. And it's the whole digital platforms which cater to this large-scale digitization that's taking place in India, which is mostly India for India. And within digitization, within the digital platforms, we are obviously looking at newer sectors. We are aggressively looking at space tech, given the success that India has achieved in space technology, and the fact that low-cost space solutions are being provided by India. The other sector where we would shortly announce an investment is in the semiconductor space, where again, there are pockets where early stage companies can come in and grow. Apart from that, we are carrying on looking at newer sectors for our fund, at least in agritech, where again we will announce. The first closure we did from Fund 3 was a climate tech company, which again is the first time for us as a fund. So these are the sectors we are looking at, but from a larger theme perspective, we carry on in B2B SaaS and digital platforms.
Mr. Majumdar, what is that first average check size that you are looking at as of now?
From the front three, the first check we would do is anywhere between $1 to $1.5 million as a first check. And as I mentioned, only 20% of our investable corpus we use to create the portfolio. So any of the faster growing companies, any of the larger and more successful companies, we would keep on investing in them up to about $10 to $15 million. And we start taking exits from a Series C, Series D onwards. So the first check will be the $1 to $1.5 million range, and subsequent investments among the more successful companies up to $10 to $15 million.
Could you just walk us through in terms of some of the details of the second fund? What are some of the companies that you had looked at?
In the second fund, which we did in 2020, we again focused on, as I said, the digital play that is taking place in India. One of the big differentiators we have is VCs normally tend to stay out of sectors where there is seen as a potential, where the companies are subjected to government regulations and or government interference, so to say. We, on the other hand, believe that in a country like India, those sectors will grow rapidly where there is a very strong government intervention. So some of the sectors which we have invested are normally sectors where the standard VCs do not invest. For example, power sector is a sector which very few VCs have invested in, if at all anyone. So we've invested in a company called Probus, which is in the power sector. And as the power sector is being digitized, as smart meters are being rolled out, this company is scaling up very fast. Again, a very differentiated company. Similarly, we have invested in a company within the EV battery swapping area, which is a clear leader in Western India. Again, the company is growing very fast. These typically are sectors where normal VCs don't invest, but we rapidly go ahead and invest in these sectors. So our investment strategy is very different in the sense not only is it tier 2, tier 3 focused, but it is again focused towards businesses which are using technology to bring forth changes rather than investing in those companies which are, tech for the sake of tech, launching a tech and then finding a used case. So ours is more tech-enabled businesses.
Okay, so we have spoken about the companies, the sectors that you're looking at, but what about the companies that you're avoiding or sectors that you may look to avoid? And are you steering away for some of those high cash burn companies or businesses like the D2C business or consumer internet, content business? Is that something you would be avoiding?
Fundamentally, every firm has a sort of different DNA. And we have a strong point of view that, these consumer internet businesses or media content businesses are winner takes all businesses. So there will be one winner in this whole, in that whole vertical, which will give potentially to an early investor 100 or 200x return. But for that winner, you'd have a large number of failures. So you would have to go deep within the sector, and a sort of early stage investor would need to do a spray and pray within the sector. That's not fundamentally our investment thesis. We believe in the types of businesses we are investing, even if there is not 100x return, although we do have one company which has given us 100x return. But, even if there's not 100x return, from a portfolio perspective, the portfolio will easily be able to give between a 4 to 6x return. And that is where our investment thesis is. Also, both me and my partner, Anil, we come from the world of real businesses. My exits have been in businesses which have been in the back end side of the industry. And we believe that, these are the businesses which will give you a return, and there is always a buyer for such businesses.
And finally, Mr. Majumdar, just let's talk about the Bharat story as well. That also is something that you have been focusing on, and how are you looking at that story play out?
This is something which is passionately close to our heart. And, if I take a step back and if you see, and I keep giving this analogy, if you see the Indian cricket team, back in 20 years ago, It used to be only from Mumbai, Delhi, and Bangalore. Exactly the three regions where today most of the startup money goes into. Fast forward today, the Indian cricket team, you don't even know where the players are coming from. I see a same thing happening in the whole startup world simply because of the government push. There is so many Atal tinkering labs which have come throughout India. There is so much of the regional colleges that are there. There is so much of an entrepreneurship wave which has been inculcated. So we see startups coming throughout India. And there is a fundamental difference between startups that tend to come from these places and from, typically these 3 or 4 regions, is that these entrepreneurs are basically seeing a real life problem around them, and then they're using the tech to solve these problems rather than developing a cool tech which is being developed in the valley and then looking at the use case for that. Fundamentally that's one big difference. And the second difference we see is obviously the high resilience of entrepreneurs who come from these regions. Even if there's a funding winter, even if there's a slowdown, these guys are true entrepreneurs. They shut down their hackles, survive the bad times and come back. And we have a number of used cases like that in our portfolio where companies went through a couple of bad years, survived back and now scaling up very fast. So we see a distinct difference in the ethos of entrepreneurs, and that's what we tend to back. Having said that, we obviously have very successful companies in these 3 locations as well, and nothing to take that away. But we, as a fund, strongly believe that there's a lot of value left in investing in these places because not very many funds look at them. It's not easy to build a deal flow structure where a lot of deals are coming from all of that, and that's our inherent competitive advantage.
Okay, thank you so much, Mr. Majumdar, for joining in with us this evening on ET Now, and thank you so much for that. But let's keep it